Guys, Beau Eckstein here. On today's episode, we're going to flash back to the Business Ownership Summit, which I hosted just a few weekends ago. On today's episode, we're going to present Michael Reeder, who is a CPA. He specializes working with new franchisees and small business owners. And this is like an action-packed 50 minutes of pure reasons why everyone should own a small business. Specifically, even if you want to keep the corporate job, that high-paying corporate job, owning a small business can potentially offset that W-2. So, guys, I'm telling you, watch this video, and I think you'll get a much better picture of what's possible. And also, I recommend engaging somebody like Michael so you could really incorporate tax strategy into your plan, because owning a small business, in my opinion, is the best tax strategy you can possibly have. So whether you want to keep the job, whether you eventually want to leave the job, you want to add an investment to your portfolio like owning a franchise, this will open up your mind to all of this. And you can watch the full day. The full workshop is still up. The replay is still up at businessownershipsummit.com. I highly recommend you watch that. We've got deep dives on different franchise models. We have conversations with operators that own quite a few franchises. We have conversations on laundromats. It is a great video to watch. So go to businessownershipsummit.com to watch that. And also stay up to date. Every month we're doing a live event on Zoom, different virtual events. So you should follow the Eventbrite page that we have. I'm actually going to put, I need to put a link. You know what I'll do? If you go to beaueckstein.com, what I'm going to do is go to beaueckstein.com. I'll put an events tab on there, and I'll put links to all the events that I'm doing. That's a good idea. Okay, so that's what I'll do. Go to beaueckstein.com. It's not there yet. For the next few days, there will be a link on the top that says events, and you click on that, and it'll have the events that we're hosting on a monthly basis, so you could stay abreast of what's going on. Get engaged with our community. I want to help 10,000 aspiring entrepreneurs become business owners in the next 10 years. And the only way I could do it, if you guys get engaged and you see the value of what can be created utilizing SBA financing, seller carry, all of this. And really, if you learn how to structure these deals, you really need a small equity injection. That can come from an investor partner. So we put together the most powerful lending product, which is SBA financing, and we help you find the ideal business, because that's really what we're doing. In May, I think it's May 11th, we're doing Business Ownership Launch, which is an incubator. So after you attend that workshop, the goal is to get you in a business within the next 60 to 120 days. We also have an event April 3rd, which is geared for real estate professionals. What business would be good for realtors, mortgage brokers, investors? What type of franchise models would be good fit for them? So we're doing a lot for the community. Stay tuned in, subscribe to this channel. And of course, if you have anybody that's looking for SBA financing or looking to buy a business, have them reach out to me. You can go to bookwithbeau.com. Anyways, without further ado, CPA, knowledge bombs, you're gonna love it. Let's go. Today's event's the Business Ownership Summit. Many of the people that are out there could be W-2 employees, some real estate investors, and really we're just diving in. We've already had some questions on how to select the right business entity. So I really wanted to today is kind of go back to when I met you for the first time, and I'm firing questions, and we're talking about just Section 179, and I think if you could start with the framework of, my concept is, look, everybody, whether you want to keep the job, the corporate job or not, should own a small business, and kind of open the minds of what some of your clients do, for tax strategy, and if they're buying trucks for their home service business, or the write-off possibilities, and open people's minds, because I think a lot of people in the corporate world, because they're taxed at the highest and worst tax barrier, they don't understand the whole other side of entrepreneurship. So I'll kind of let you do a little bit of an intro about you, and then we'll dive in. And I encourage anybody that's watching, as we start kind of opening up and unpacking this, feel free to go into the Q&A and ask your questions. Thank you for joining
Sounds
us.
good, Beau. Yeah, thank you for having me, Beau, and it's great to see everyone here. So, my name is Michael Reeder. I'm a CPA. I'm the owner of Reeder CPA Group. I now own the firm that hired me out of college and switched the name to Reeder CPA Group. 37 years old, been doing this for about 13 and a half years. And I've carved out a niche for myself as a CPA in the franchise and business buyer world for approximately the last 9 years. So, rounded up to a decade. And so let's just go into what you were talking, Beau, about depreciation. That's a good topic to riff on for a little bit. So it all comes like, so in this context, we're talking about, there are a lot of people here in the audience that are W-2 corporate employees, as you mentioned, and so that what's important to understand is that the Internal Revenue Code is written for the self-employed taxpayer. The Internal Revenue Code is written for the business owner. It's not written for the W-2 employee, whether it's corporate or not-for-profit or government. Just W-2 employee. There's really not much that you can do from a tax perspective other than max out your qualified accounts like your 401k, IRA, HSA, flex savings plan, et cetera. And so when it comes to business ownership, and let's say you're going to do a startup, right? And it could also be an existing business that's cash flowing, but there's this thing called depreciation of fixed assets. So whether it's a vehicle or a piece of machinery or furniture, a lot of leasehold improvements, a lot of these are assets that are hard assets or fixed assets. And so because of depreciation rules in the Internal Revenue Code, there is the allowance for what's known as accelerated depreciation, and it allows you to write off either the majority or all of the big ticket fixed asset in the year of purchase. And so, for example, if you're starting up a business now, and you're starting from scratch, you're going to invest in a franchise, for example, that you're going to ramp up from zero. So you're going to start out, you're going to be in the red because you're starting revenue from zero, but you have startup expenses that you're incurring immediately. And a lot of those expenses commonly are a vehicle is a common one. And if it's a business that has an actual brick and mortar, then you're going to have a build out and furniture and fixtures and machinery, equipment, et cetera. And so due to the combination of being in startup mode, coupled with the fact of having these fixed assets that qualify for depreciation, you're going to build up this loss, okay? And this loss for tax purposes. And we're in March, this is and then if you ramp up your business amazingly over the next 10 months, then God bless you. You still have 10 months of this year to actually have a profit even after depreciation. But let's just assume that it's going to be a loss because it's startup mode, because it's the startup year. And how you're structured. See, there's so much here, and I have to make sure I don't rabbit hole too much, because now it's well, how are you structured? What's your entity structure for your small business? So the key here is to be structured as a flow-through entity, right? So that flow-through entity is an LLC or an S corp primarily, right? So whether you're taxed as a sole proprietor LLC or a partnership LLC or an S corp LLC or just a regular S corp, in any of those or just a regular partnership. In any of those contexts, the profit or loss from the business is going to flow through to and be taxed on or reported on the personal tax return. So I'll bring it in for a landing. Startup business, due to the combination of startup and accelerated depreciation of fixed assets, you have $100,000 loss, all right, after factoring all those things in. And it's an ordinary loss, right? And so we're going to talk about ordinary versus we're going to talk about non-passive, aka ordinary, or passive. Then we'll talk about real estate investor versus real estate professional. We'll dive into all that. But in this context, you're going to have that $100,000 loss is going to get reported on your personal tax return, and it's going to net against your $300,000 W-2. So now your AGI is $200,000, but you have enough tax paid in on $300,000. So you're either going to get you're going to either owe less in tax, or you're going to get a much bigger refund. And you can do that because of this business loss that nets against your corporate W-2, your day job.
Meet Beau Eckstein, the driving force behind Business Ownership Coach, unlocking the path to business ownership. Visit www.businessownershipcoach.com. Thrive with Business Ownership Coach.
So first of all, guys, I think you can see that this is why you want to talk to a CPA like Michael. because the strategy of what entity type, and really, if you heard what he said, you want it to be a pass-through for tax purposes. So my question is, I just bought a Ford Expedition, brand new. It was like $75,000. I financed 100% of it. It was 100% for my business. And let's just say after all my other write-offs, I still have about $100,000 gain. And can I write off typically? I mean, I know there's different scenarios. What am I able to, because I know it's over 6,500 pounds. How does that $75,000 purchase, if it's 100% for my business, how would that help from a tax strategy?
So high level, that would reduce your taxes. There's a chance that you can write it all off. Okay. But now we have to go into the weeds a little bit here, because we're talking about one of the three most commonly audited expense items, right? Which are automobile, travel, and meals. It used to be meals and entertainment, but now it's just meals. So automobile, travel, and meals. Those three expenses, we always want to give the eyeball test each year, because they can be audit flags. So in Beau's example right there, first of all, I like, Beau, how you said you purchased it, but you financed all of it, because that does two things. That one, it gives you because you own it, you don't lease it, you can, it all qualifies for accelerated depreciation, whether it's section 179 or bonus. And also you preserve your cash position for other working capital purposes because you heavily financed it. You would be able to write it all off. But I would say, now this is something where you talk to 10 different CPAs, you can get 10 different answers. First of all, make sure that you document what the business purpose is going to be. So are you going to be using it to, are you using it only for business, or is it also is it a business vehicle that you also use to go to the grocery store, pick up the kids, et cetera, et cetera? I'm a fan of going the actual expenses versus mileage. And we're going to dive, you can see how I'm kind of going off into like mini tangents as I'm giving the answer, and we can like talk about each mini tangent. But I like to go the actual expense method, which means the depreciation of the vehicle plus anything that you pay out of pocket for fuel and tolls and parking and car wash and repairs, et cetera. And I would write it all off, just to throw the IRS a bone. How I've been trained from the CPAs that are in their 70s and 80s now that have trained me as I cut my teeth in this industry in Chicago. I'm a fan of adding about, like reducing it by about 20 or 30% at the end of the year before we file the tax return, with a negative expense entry called personal use of auto. So we show the IRS, hey, yeah, we wrote all this off, but this is also the same vehicle that we use for personal use. And so we're backing some out. And so now one of the natural questions would be, well, what if it's not used for personal? Now it's all right, even if it's not used for personal at all, we might strategically just want to, back out a little bit for personal, again, just to throw the IRS a bone. And then it also depends what industry it is, right? Like if it's a construction company, then I'm more comfortable like writing off a bunch of trucks because it's a construction company. If it's a franchise consultant or a real estate broker, some sort of service professional, chances are that service professional is using that same vehicle for business and for personal. Like, it could be wrong, right? But so it's like the industry matters in terms of, how like what position we're going to take on the tax return when it comes to automobile write-offs.
Very good. So we have a lot of people that are, we have actually Mark Hale from Naturals to Go coming to speak to later today, who does vending, right? So I'm buying 10 vending machines. It's $100,000 or whatever. That seems to be like obviously a good business for section 179 so if I was a W-2 employee and I purchased 10 machines for $100,000, and I made I made $100,000 on my W-2, in theory, I would have $100,000 from this purchase of these machines. And then how do we know, like, what is the difference between bonus depreciation and section 179?
Yeah, great question. So yeah, and it's a great question, Beau, because as if you're all listening, you notice how I say accelerated depreciation as the umbrella term, because there's two types. There's bonus and there's section 179. And so, yeah, businesses such as Naturals to Go, like vending machines, and also portable storage like units and Go Minis. Like these are businesses that are great from a from a tax savings perspective because a lot of the startup investment off the top of my head, I don't even think Naturals to Go has a franchise fee. I think that's just you pay for the machines.
Yeah, they don't because they're not a franchise.
Yeah, just a business opportunity. So the entire investment, the water station technologies is another example. So the entire investment, if not either the majority or the entire investment, qualifies for machinery and equipment. So you can just write off the whole thing through accelerated depreciation. The difference between bonus depreciation and Section 179 depreciation is bonus depreciation, even if the entity is already in the red, then bonus depreciation will further drive it into the red. So it'll increase the loss, right? So in that example, if you have a $100,000 W-2 and you have a startup business that has zero revenue and $100,000 of depreciation, then that in bonus depreciation, the entire depreciation will increase the loss. Whereas Section 179, you can deduct Section 179 in the business to the extent of profit. Once you're already at zero or in the red, then the remaining amount of depreciation on Section 179, you still get credit for it, but as a carry forward. And so it'll offset subsequent year income. So in that example right there, it's more beneficial to go bonus depreciation for the vending machines versus Section 179.
So kind of unpacking this a little bit, just so I can kind of maybe make an example so people that are watching right now. So if let's just say I made 200,000 on my W-2 and I paid in a portion of what I pay in my W-2 is Social Security, and so how would I just kind of rough numbers? I know we can't really do it, but if I made 200 grand W-2 and I bought $100,000 of these machines, what's the formula, I guess, to make it to kind of make it simple?
Yeah, so I'm getting a little notification that my internet is unstable, so just keep me posted, Beau, if I am getting choppy.
Yeah,
but
you're good right now.
Okay.
You're good. Yeah.
So $200,000 W-2, $100,000 of a loss from the business because it's all the depreciation from vehicles. So what that means is that on your tax return, right, you're going to have a $200,000 W-2 and a $100,000 loss either on Schedule C or Schedule E via the K-1. So what that means in English is that your adjusted gross income is going to be $100,000, right? But then on your W-2, you withheld federal withholding based on 200,000. So you're gonna, then from the 100,000 of adjusted gross income, let's just assume that you're gonna, you're married joint, you're gonna have a standard deduction of somewhere around 27,000. So now you're at 77,000 taxable income. So your taxable income is 77,000. And then do you have kids? Do you maybe qualify for child tax credits? That chops it down a little bit. So let's just say a couple kids. Now you're at 73,000 of taxable income, but you have and then your tax comes out to, gosh, I don't know, just for the sake of conversation, on 73,000, your tax comes out to somewhere around 20 grand, call it 17.5, right? But on your W-2, in box 2 on the federal withholding box, you see that there on $200,000 of income, there's 37.5 of withholding on that, right? So you're going to get $20,000 back when you file your taxes, as opposed to breaking even or maybe getting a small refund or a small balance due.
So this is why I preach that everybody should own a business. Pretty much everybody should own a business, and it could be more of a passive type of business where it's you're just renting luxury porta pots or whatever, right? Something where you have heavy equipment. It seems to be a good, if you're just trying to do the tax play, would probably be a good place to start. What other strategies are you seeing with your clients that maybe would open up some people's minds? Because I think a lot of people, I'm starting, and I'm not a CPA or tax attorney of any sort, but I try to learn this stuff just so I know from a strategy standpoint the questions I would ask my CPA, right? That's really, you want to, because I think a lot of people, I hear this a lot. I'm in a mastermind group, and there's 900 millionaire guys in this group, and everybody's always looking for their CPA, and right, there's CPAs that get it, it seems like, and then CPAs that don't. I always feel like I always see these posts that like, hey, I'm looking for a CPA. And that's why I encourage people to like attend. That's why I wanted you here, is because I want you guys to open your mind to like, look, there's ways like, and it's written in the tax code to play the game legally. And why not play the game and not, instead of paying 50 grand in for taxes or 100 grand in for taxes, what if you could buy a business that's going to appreciate? You can sell later in life. You're going to get the depreciation, and then you're going to get the cash flow from, and also have an amazing, tax write-off. So what are some strategies and what are some changes in tax code? Just some kind of, we don't have to go too into the weeds, but things that people should know, that because most of the people that are watching are here at Business Ownership Summit because they want to buy a business.
Right. Yeah. So, I mean, it's to your point. I mean, like everyone, like you and I are on the same boat, right? Like everyone should own a business for the reasons mentioned. And there are arguments, if some people are happy with their W-2 job with the benefits and like the 9 to 5, they can shut it off and they're happy with their life, then God bless them. But like, those people are not here. The people that are in attendance here today, like you are all interested about, investing in a business, whether it's a startup franchise, a franchise resale, or an independent resale, for example, or anything in real estate. And so, that implies that, you're looking for something different. And so yes, the one of the major benefits of being a business owner is the tax code, as we've discussed. And so, I mean, it just gets down to, I mean, we talked about depreciation, but there's just, all business expenses qualify for a write-off, right? So there's, if there's a franchise fee, then, that has to be capitalized and amortized over 15 years. Entertainment's not deductible. And meals is back to 50%. But pretty much like all of your normal, expenses like payroll and marketing and insurance, like everything that you're incurring is a write-off against your self-employed revenue, right? And so just the fact, just right there, it's just the fact that you can write off all of your business expenses is a benefit, right? If you're a corporate employee, unless your employer has a, some sort of like expense reimbursement policy, then anything that you're out of pocket when you're traveling or for your home office for your corporate job, you can't write off. So you're not getting any tax break for that. So just pretty much like just the fact, so now it goes down, you want to have a good bookkeeping system. See, that's the thing. You can write off a bunch of stuff when you're a business owner, but the IRS puts the burden of proving those expenses on the taxpayer. So now that comes down to like having you have to have a strong accounting internal control. So are you, like, when you're starting out, are you just doing spreadsheets? I would advise you to get into a QuickBooks Online structure with your bookkeeping. Just get into a cadence where, whether you're DIYing it or your spouse is DIYing it or an internal employee or a third-party bookkeeper or your CPA is doing the books for you on top of tax preparation. There's multiple ways to skin the cat there, but just have a bookkeeping system and just get in the habit from day one of tracking all your expenses, because that is going to be your primary source material from which you can use to claim deductions on your tax return. And then God forbid you were to ever get audited, right? And you can hear, like I was talking earlier, a big part of the strategy is to not get audited in the first place. But if you ever were to get audited, then the IRS is going to want to see your books and records. And if you don't have books and records, then it's going to, you might get, taken to the woodshed on that audit. And so, so just having a good internal system, a good internal control for tracking all of your expenses, right? AKA a good bookkeeping system. That alone gives you the ability to make sure that you're maximizing all of your write-offs, right? And then so it's very basic, it's very elementary, but that's just it's amazing how many small business owners just always fall behind on their bookkeeping. And tax season is this fire drill of getting the last 12 months caught up. And so that, and having a relationship with the CPA that is a proactive tax strategist, as opposed to just a tax preparer. As you go into the fourth quarter each year, you should already know where you stand for that year. Are you gonna, you should already know what your tax liability is. Now, your tax liability is one thing, and then how much you have paid in is another, right? So you should already know where your tax liability is through the end of when you go into the holidays in Q4. And then, do you have enough paid in that you're going to be overpaid or break even, or are you actually going to owe money, but you're going to true up on January 15th with an estimate, or on April 15th with either a balance due or an extension payment. A good CPA always is working with you as the client throughout the year in a year-long dialogue, planning, so there's no surprises, and you're able to do everything optimally during the year in order to keep your taxes low. And so, we talked about section 1, we talked about accelerated depreciation. There's so many things that self-employed, there's so much to talk about in the context of self-employed retirement plans. It goes way beyond just a regular 401k, right? And now this, are you going to have employees? Is this just you? Are you in a business where it's just you and you have labor, but it's all 1099 labor? Or is it you and you have W-2 employees? There's 401k plans. There's the ability to put a Roth inside of your 401k. And that's more beneficial than just a regular Roth because there's no income limitations to it. And you can also do the full 22.5 salary deferral to Roth each year. So, there's different types of 401ks that you can have. There's a type of 401k called a safe harbor non-elective that allows you to pretty much give everyone a little employer contribution, no matter whether they contribute out of their paycheck or not. But then that allows you as the owner to put away more in salary deferral and profit sharing without having to give like a huge chunk to your people. But then again, it's like, if you're making so much money, would you rather give excess profit to the government or your team? I think we all know the answer to that question. There's defined benefit plans, like, cash balance plans that you can stack on top of a 401k. There's SEPs. I tend to be more of a fan of a 401k than a SEP. But SEP or 401k, those are defined contribution plans. Defined benefit plans are pension plans, like cash balance plans. Like, there's just so much that you can put away if you have enough cash flow, right? Like, if you're in a situation where you're bringing in all this revenue and you've written off everything, you section 179 the truck, you've done this, you've done that, and you still have a profit, then by having a self-employed retirement plan or multiple self-employed retirement plans, depending on your cash flow and how much you need for working capital for the next year, you could just put massive amounts into retirement. It's crazy. Versus just the limits that you have at your day job's 401k, where you can just do the 22,500 out of your paycheck, and then and you can also do IRAs too. But still, self-employed retirement plans just alone are a massive part of the strategy. Go ahead, Beau.
Yeah, no, I was kind of, my feedback so far is look, there is so much you can do. This is why I wanted, this conversation is such a big piece that people just don't talk about. And I don't get it. I'm like, look, because I talk every day, I'm talking to people either buying business, so they want to talk to me about buying a franchise. And a lot of times they're not even thinking about tax benefits and tax strategy. And it's like, it drives me crazy now. Because I'm like,
you want a big problem of it? A big problem, Beau, is because because of the H&R blocks and the Intuit TurboTaxes of the world, tax preparation to a lot of the marketplace is just this commoditized thing. It's just this thing that you just go in January through April, you go to the tax return vending machine, you put in a quarter, it spits out a piece of paper with some numbers, and you have no idea how those numbers were arrived at. And it's like, okay, that's what my H&R block person told me, so that's what I owe. And then boom, it's just like this. Their tax preparation is commoditized, right? But tax planning, strategic tax, is not commoditized at all. And the modern CPA needs to be the latter, right? The modern CPA, like, you need to work with a CPA that's a tax strategist, a tax planner. And yeah, it's implied within the service, within the annual working relationship, there is part of the service includes filing taxes, but the real value of the relationship is the dialogue throughout the year. Having a relationship in which there's a monthly fee in which that makes sense for both sides, that's reasonable, that has baked into it the cost of tax preparation plus X amount of tax planning throughout the year, because that creates a framework in which you're just in dialogue with your CPA throughout the year, talking about the strategies and then implementing the strategies, and then everything that's being implemented is being put on the tax return. But so that's I'm with you, Beau. So many people are just not doing this because we're the way that the industry's been commoditized over the last several decades. People just, this is, I just want to pay $100 for my tax return. And if I have to pay $200, that's too expensive. When really, and then as a result of that, they're actually paying more because they're getting hammered in tax, especially if they're self-employed. They're getting hammered in taxes, and then so many CPAs, so many accounting and tax professionals out there are again another fascinating topic for another day. But it's just what you have is you have first of all, a lot of baby boomers are getting out of the game, right? They're retiring, they're selling their practice, like CPAs, CPAs in their 70s and 80s want to get out. Kids don't want to go into the industry anymore because it's too stressful with deadlines. They just want to work at a fintech startup. And then you have all the existing accounting and tax professionals, right? On one side of that spectrum, you have the mid-market firms, which are, like not the big four and like not even like the major market firms underneath the big four, but I'm talking like the mid-market firms, the big regional firms. If you go them, they're super expensive, right? Like they're going to want a $10,000 retainer before you even like walk in the door, and they're going to probably pass off a lot of the legwork to an intern. And then on the other side of the spectrum, you have H&R Block. And then in the middle, you have a bunch of boutique CPA firms that are just at max capacity. They're at max capacity. They can't take anyone else on. They're just so stressed with so that's a problem. So like the way that I've built my firm is to I'm leveraged to it. I've got a great, but anyways, like this has been a problem that I've been racking my brain around as a CPA. Well, how do I solve this problem? How do I be able to provide valuable service and meet the market at reasonable price points? And so, I like to think that I figured it out, but the figuring out is also this continuous thing, right? Like we're always Kaizen, continuous improvement, always, right? And so, but because of that, it's because in today's culture, the status quo with tax preparation is just this thing that gets done January through April, and it's a fire drill to get last year's taxes done, and you're finding out for the first time in March or April what your tax liability was for the previous year, and then it's just the same hamster wheel again and again and again. And the wealthy people, the successful business owners, they're not doing that. They have a relationship with their CPA, which they're in dialogue throughout the entire year, and in that dialogue there are creative strategies being discussed, and then subsequently those creative strategies are being implemented. And whatever they're paying in fees, I can assure you is definitely worth it because it's reducing their tax liability each year massively.
EquityInjection.com is the perfect solution for aspiring entrepreneurs who want to acquire a cash-flowing business. We've partnered with a leading mortgage advisory firm to help you secure the most advantageous SBA financing and overall capital structures for your business. Contact us today to learn more about our equity investment service and take the first step towards the success you deserve. Visit EquityInjection.com for more information.
All right. I think Bill's got some questions for us.
Yeah, we have a lot of questions, but the first thing I want to get out of the way is how does one contact and start working with Michael? So give us some details on contact and stuff like that, phone number, email, whatever.
Yeah, so I have an office phone, but I love what I do. I like to give my cell phone out, right? So like my cell phone, 847-302-3397. That's 847-302-3397. Call and text me at that number. If I don't answer, leave a voice message. My email, Michael@ReederCPAGroup.com, Michael @ReederCPAGroup.com, REED as in David, ERCPAGroup.com. I'm on LinkedIn. I got a website. You can submit an inquiry on the website, but you can just get a hold of me, and when we schedule, I can loop in someone from my admin team. We can get a phone call scheduled.
Perfect.
All right, so we have about a dozen questions right now, so we're going to try to kind of do this rapid fire and in no particular order other than the order they came in. So can write-off expenses be written against retirement income, i.e. pension and or Social Security, for those of us who are no longer have W-2 income?
Yes, because in this context, if you're collecting Social Security or a pension, and or you're taking distributions out of your 401k or IRA, then and then at the same time you invest in a business, exact same thing that we talked about, a flow-through entity. That flow-through entity has a loss, for example, right? Like for the startup year or for whatever year, revenue minus expenses in that business is a loss, and that loss is it's in a flow through entity. That flow through entity is going to flow through to the personal tax return, and on the personal tax return, there's $100,000 of pension income from the 1099-R and a $70,000 business loss. Then your adjusted gross income is going to be $30,000, and if you have any tax withheld on the pension, that's going to be the same thing as a W-2. Exactly. So the answer is yes.
Perfect. How tax loss works when we buy an online business? Can we accelerate depreciation, and how to maximize deductions for our down payment and all ongoing investments? That's a pretty
So it
broad
all,
question.
yeah. So I mean, it all comes down to if you're purchasing an online business, that implies that it's a resale, and so it's an asset purchase, and then so it all just comes down to like what is the classification of the assets that you purchased, right? Like anything that is like a fixed asset, like any sort of like if there's any sort of inventory or anything that is like a machinery or equipment, et cetera, like that's going to qualify for accelerated depreciation. You know, the inventory you can write off the cost of goods sold. And so, but if a big piece of it like is goodwill, right? If it's goodwill is an intangible asset. And so intangible assets like franchise fees and goodwill, these are what are known as Section 197 intangible assets. What that means in English is that you have to capitalize that as an asset, as an intangible asset, and amortize it over 15 years or 180 months. So there's some limitations on intangible assets versus hard assets.
Perfect. This one has to do with the Roth SEP. Can you take out what is contributed at any time and just leave in the profits from the contribution, like with Roths?
Yeah, so with anything with Roth, any sort of Roth, you can take out original contributions at any time. The restrictions for Roths apply to earnings that are inside the Roth and also conversions, right? So it's like if you have a $500,000 in a Roth right now, but it's because you converted 500 from pre-tax into Roth and then you paid the tax, whatever, like whatever the remaining amount that's in the Roth, that is subject to a 5-year holding period because it got into the Roth via conversion as opposed to original contribution. Okay. And then you put 5,000 into a Roth and now it's worth 8,000 because it earned 3,000 while it was inside the Roth. There's a 5-year rule that applies to the 3,000 earnings, but the original contributions into a Roth, you can take out at any time, tax and penalty free.
Do you work with small growing entrepreneurs and help to tax strategize throughout the year and with filing the return?
All day, every day, twice on Sundays.
Awesome.
Yes.
Are there ways to reduce the self-employment tax?
100%. That's the main thing for S corporations. S corporations. You hear a lot of people, talking at the dinner table, at the happy hour or whatever. Oh, my CPA told me I should be an S corp. I should be an S corp. I should be an S corp. Why? Why an S corp? Why an S corp? S corp is for one thing and for one thing only: to save money in self-employment taxes. That's it. It doesn't save you in income taxes at all. Self-employment tax is another term for Social Security and Medicare taxes. It's 15.3% of net business income. And what you do is if you're a small business owner and you're taxed as I'm not going to rabbit hole. I'm just going to say, yes, it is. The main strategy to save money in self-employment taxes is to be an S corp, and that only makes sense if you have a profit. If you have a loss, you're not paying any self-employment taxes. You have a loss, and if you have a profit, then you're paying self-employment tax. If you're a partner, if you're structured as a partnership or a sole prop, and you can save money by converting that sole prop or partnership LLC to an S corp, and you can save a lot of money in self-employment taxes each year, and that makes sense to a certain point. And then when you get to a certain point where you're making a bunch of money, then you bring the self-employed retirement plan aspect into it, and then that makes that determines how much salary that you make. And so the self-employment tax savings, it makes sense to a certain point. Then like once you're like $300,000, $400,000, $500,000 and above, self-employment tax is more of like a non-issue at that time because you've way exceeded the Social Security wage base, which is 12.4%, which is the lion's share of the 15.3% self-employment tax. The other 2.9 is Medicare.
Should I use a CPA that is familiar with the handyman industry, or should a qualified CPA already have an understanding of the industry?
The latter. A qualified CPA should already have an understanding of the industry. So I don't hold myself out as like a handyman, like for example, right? Like I don't hold myself out as like I am the CPA for like handyman, but I have multiple clients that own like handyman franchise businesses, for example, and it's still a self-employed activity. And so, yeah, the latter, a qualified CPA should be able to handle it.
All right, awesome. Can you talk about the home office expense, how it's changed? Kind of what are the pitfalls and what are the things you kind of like need to be aware of and like,
Yeah. So if you go on my website in the resource section of the helpful links, we have a home office worksheet. And essentially, the main thing with the home office is, I mean, there's the regular way of calculating it, and then there's the simplified way, which is just like $5 per square foot. And so the main thing, again, like not to rabbit hole, because I can talk about home office for 20 minutes. The main thing is to just not be too aggressive with the business use percentage. So the IRS will say that, so the home office, cannot double as a personal room. So if an IRS auditor were coming to your house next week to audit your home office, and they say, "Where's my home office?" Like, okay, like which room is your home office? And you say, "Oh, it's my living room or my finished basement or my kitchen." They'll say, "Nope, doesn't count, because that room doubles as a personal use room. It needs to be an actual room in the house that's designated as the home office." And so the square footage of that room divided by the square footage of the entire living space equals a number. And if that that's the business use percentage to apply against, the 100% of the mortgage interest and property taxes and the cost basis of the house and the repairs and the association dues and the utilities and blah blah blah. And if you do that, if you say, "Mike, I measured that square footage, and like this is like the subjectivity," you can talk to 10 different CPAs, get 10 different answers. This is my subjectivity on this one. If you do that and you come back to me and say, "Mike, I measured the square footage of my home office, it doesn't double as a personal room, and it came in at like 21%, I would say, let's cap it at 17.5. Like I like to just like use 17.5 as like my, like, even if it is like legit 21% business use, let's just cap it at 17.5. I just don't want to get too aggressive with the home office business use percentage. Like most likely it should come in somewhere around like, I don't know, between like 5 and 10%, like, more like 5 and 8%. And so it's like, if you're telling me that it's like, 21%, let's cap it at, and it's like my comfort level is I'm not going any higher than 17.5%.
perfect. Next question is, it's regarding Roths again. What if money transitioned from 401k, 403b, rolled to a traditional IRA, and then transferred to an existing Roth that has been held for 5+ years? Has 5-year holding period been met? What about
No.
Okay.
Oh, sorry. Go ahead.
What about Roth 401k, 403b rolled into a Roth IRA? Does the 5-year holding period apply?
So for the former, no, and for the latter, yes, because in the latter, it's already Roth and Roth, right? But in the former, it's pre-tax to Roth. And even if the Roth that it got rolled into has been around forever, it's that 5-year on that conversion starts from the day of that conversion.
Perfect. Last one that I have so far. Tax prep, accounting, bookkeeping services, those all sound like an expense, but just confirm for us that those are actually expenses against your business and you can write those off.
Absolutely. Those are all professional service expenses, like lawyer and accounting and bookkeeping and all that stuff. Those are ordinary business expenses that you can write off in full.
Yeah, man,
Okay, that's all the questions I have so far. There might be a few more coming in, but Beau, you probably have a few as well.
Yeah, I mean, my brain's kind of spinning right now. I mean, as you guys can see, there's a lot of variables. Everybody's going to have a little bit different use case. So you're better off just figuring out and getting aligned with the right tax strategist, CPA. Because I just wanted to open your minds to like, look, if you're paying taxes and you want to own a small business, or you don't want to own a small business, now you do because you heard this conversation. Now it's just a matter of finding out, if it's purely tax strategy, why you want to own the business more so than anything else. Then you got to find something that aligns with your wants and needs. And that's kind of today's topic is like, look, like maybe it's more of a passive like ownership model where you rent something like where it could be the vending or porta pots that you rent out for event bathrooms and things like that. Where, I mean, that's where some of it's got to work to see like what business model will make the most sense, because we don't know. I mean, it could be you could get some sort of executive semi-passive business model because you're still the business owner, and then you're looking at like some businesses don't have as many write-offs as others. So it just kind of, I want open your mind to like the fact that we got to figure out what business you want to run first off, right? And then what's it going to look like? So, for example, going back to the strategy of I'm going to buy some vending machines. I'm going to start with 6 vending machines or 8 vending machines, and then this year is good. We got it up and running. The business is going. Next year, my other business crushed it, and I have a lot of taxable consequences potentially. I meet with my tax strategist, and even though I didn't want to buy another 8 machines so quickly, it might make sense to do it in this tax year because of the write-offs of this extra $80,000 in machinery that I'm buying. So that's where I think the tax strategy really comes into play, is that you can do this, and that's what a good tax strategist is going to do. It's going to help you plan on hey, you're going to probably have a big taxable consequence. Is there anything we can do about it, right? I mean, is that really what tax strategy is about?
Yeah, I mean, tax strategy is all about just, I try to keep it simple, right? Like just having a dialogue with your CPA throughout the entire year, talking about strategies and then implementing strategies. If you're not talking about the strategies, then we don't know what's, and if we're not talking about it, we can't implement anything. And so it's really that simple, as opposed to just, meeting with your CPA or accountant like in tax season to get last year's taxes done, and then that's it. And then you don't worry about taxes until and it's so it's just that the proactive relationship with your CPA is what it's all about. And if your accountant is not providing that to you, and that's what you need, then you need to fire that CPA and find another one. And there are, so yeah.
Couple
Go ahead,
more
Bill.
questions. For an LLC, which state is the best choice?
So that is a very nuanced question, because it really depends on the situation. And that's all. There is a legal aspect of it that's more, so I'm a big fan of Delaware LLCs. Like Delaware is a great state for, there's already, like from a legal standpoint. I'm not a lawyer. I know enough lawyers to be dangerous. And like the main appeal for Delaware is that there's so much case law in Delaware already. So like if there any sort of dispute between owners, it's already like there's already case law in Delaware that determines how it's going to be settled. Like, so as you can tell, that's more of like a legal than a tax, right? And then when it comes to Delaware, Wyoming, Nevada, Montana, blah blah blah, South Dakota, it's just like it depends what is your business going to do, right? If you're going to have a physical presence in like multiple states, then you're going to have to, even if you're domiciled in Delaware, you're going to have to register as a foreign entity in the state where you're physically present, or the states where you're physically present. And then that's going to mean that, you always want to talk to not only the CPA on that, but also the attorney. And of course, I've got a great network of attorneys, and it's because it's not just the tax savings. If you're a California resident and you're setting up a Delaware LLC, and you have all this income from your Delaware LLC, you're still going to have to, you're still going to have and maybe you get a Delaware and you get a non-resident K1 from like any other states, but you're still a California resident. So you're still going to, K1 is still going to flow through your California personal tax return. There might be a credit for taxes paid to other states and stuff like that, but it's still going to be subject to California tax. And so you want to try to not get too fancy when it comes to entity structure, unless there's a reason to do it. Because like if you get too fancy when there's no reason to do it, then you're ending up just like paying for like multiple annual reports to different states each year, filing like multiple tax returns, and it's really too complicated than it needs to be. And that's always something that as you can start out simple, and then as time goes on and you are getting big, you can always restructure into something. And the restructuring could be not so much from a tax savings perspective, but more from like an asset protection. I know that there's a strategy, and again, this is where I need a lawyer to come in to go to rabbit hole into it, but like there's a strategy for asset protection, to have certain things owned by South Dakota trusts. It's like, don't ask me to rabbit hole on that, like ask the attorney. But like there's all those different fancy things, but it's not just tax protection, it's also liability protection and asset protection and all that stuff.
Next question is, if I open a franchise, should I have a physical location for office space if I don't have a space in my home that I can dedicate for an office?
Great question. So is this like, do you need an office space? Like, do you need a commercial office space, or is it a franchise that you can do home-based and you just don't have a home office? I'm assuming that it's the latter, right? It's the latter of those two. And so, I mean, my 2 cents, it's just the subjectivity of that is, Well, do you just like, can you not focus at the house because your kids are driving you crazy and you just got to get out of the house? You get too stir crazy in the house, then go get a commercial office space. Or I would do a co-working space in that example. I'd just get like a nice month to month, like no like annual multi-year obligation. I would just get a co-working space if you can't do it at the house. So yeah,
Yeah, if it's a home-based business, you don't need office space. There's not really a tax benefit to going out and spending $800 in an executive suite for Regis, right? Like, because that's not going to help you because you're incurring $800 a month in rent. So
Well,
right.
and think about this: the co-office space, or whatever the term is, that's a full 100% write-off, right? You
It's
go
a full
incur
write-off, and it's also month to month. So you
right.
can like just
So
do it,
you incur expenses as you need them, and it's an immediate tax write-off versus I'm spending $1,000 a month for a commercial building that I may not even use.
yeah,
right. And to your point, Beau, you were saying that it's like if you don't need it, then why incur the expense? Right. And
Right.
so and like what I would say is that's just the subjectivity of the individual. It's like if the individual can work from home in that context, there's no reason to get a separate office. If they can't focus at home and there's too many distractions, then consider getting like a small little co-working space somewhere that's month to month. And there should be some good one depending on where you are in the country. Like I would imagine that you should be able to get something good like between like $200 and $500 a month.
One more, and I think we got to wrap up pretty soon. What are your thoughts about structuring with anonymity? One attorney said it's important. Another says it's a waste of money because you will have to disclose assets if you are sued. With the new law about disclosing the humans behind the entities, how much anonymity does asset protection structures really provide in California?
Yeah, I mean it's again, I think that's more of an attorney question, but I would say, like for me personally, I wouldn't be too concerned about it. The FinCEN reporting is what this attendee is referencing. That already but that's just going to be reported to FinCEN. So like FinCEN is going to know like the beneficial owner of the entity, and so but what does that mean? Like who is FinCEN sharing that with, right? But it just seems like to me. If I'm in startup mode of a business, I am focused on ramping up my business and getting positive cash flow ASAP. I'm not too worried about anonymity. I just feel like it's more of a distraction than a benefit. And if it's something that I need, like once I actually start having wealth and I'm like, well, this is a real thing, then I can worry about anonymity later. It's just like as an entrepreneur that owns multiple businesses, I'm just not thinking about it. And I don't want to get caught up too much in the weeds with it because there's other more important things to worry about in the here and now about like ramping up my business and getting positive cash flow. Because if I'm not doing that, what am I doing?
you brought the fire today for sure. Like you are like a wealth of information. You're like a spitfire. This was freaking awesome, guys.
I loved it.
One more time your contact information, and then we'll also send it out via email.
Yeah. So Michael Reeder, CPA, owner of Reeder CPA Group. You can just plug in readercpagroup.com, on your Google bar, pop up. My cell phone is 847-302-3397. That's 847-302-3397. You can call and text me at that number. Email address, michael@readercpagroup.com. That's Michael, Michael, at readercpagroup.com. RE is David, ER, CPA group.com.
Amazing. Thank you so much, guys. I know like taxes are boring. I know that when Michael Zuber spoke first on the economics, but you can see we're painting the picture of why you want to own businesses versus a lot of people that are not real estate professionals that own like one or two rentals. And I'm like, the tax write-offs is not that great compared to like if somebody said, hey, one or two rental properties versus owning a business, there's far more write-offs as a business owner. Maybe when you get into actually being deemed a real estate professional, then you can open up some more doors. But I think like I'm like, there's no other better way that I've ever seen just like to own a business and then figure out the strategy behind what you're doing with it. And not to mention, you can quit your job eventually if that's what you want to do because you're building the cash flow machine. So.
Yeah, and just to one more thing, like that's important, Beau, that you just reminded me of is the importance of and this could be another topic for another day, right? But like the importance of cash flow versus profit, understanding the difference between cash flow and profit, and also on strategic use of good debt, because like all of us Dave Ramseyans, who I love Dave Ramsey, but like, I think Dave Ramsey is more of like the context of like personal finances. I think like when it comes to owning a business, like for me, when it comes to owning a business, because I've experienced it myself, like as a business owner, like accumulating my own wealth, strategic use of good debt, and like I won't, that can be like for next episode for whatever, but and also with like what's great about startup franchise, if you're going to invest in a franchise as a startup franchise as opposed to a resale or an independent non-franchise resale, startup franchise businesses qualify for SBA loans. You can't do a startup independent business and go get an SBA loan, but you can for a startup franchise. So to be able to invest in a business, doesn't necessarily mean that you have to come out of pocket for the whole thing. Like you can invest in a startup franchise that has a $250,000 investment and just come in with a $50,000 down payment, and the SBA funds the rest of it. Like to be able to do that as a startup is huge. Leverage, like businesses and real estate are great ways to accumulate wealth, but to Beau's point, you can accelerate it with business. Unless you're going to really develop a portfolio of real estate, you can use the leverage strategy to ramp up and preserve your nest egg. So that doesn't mean a $250,000 investment does not necessarily mean you have to come out of pocket $250,000 or do a HELOC, leverage your personal assets or deplete your personal assets for the whole thing, So like that's very important. The SBA for startup franchises and just understanding strategic use of good debt and also understanding the difference between cash flow and profit. All that stuff is like another topic. We can talk for like hours on that.
Yeah. I work with one bank and I bring them a lot of business. They do 90% on franchise startups. So 90% of total project cost for loans up to 350. So yeah, I mean, Michael, thank you so much. Like, yeah, we'll continue on this because there's a whole debt equation. There's a whole, other piece of it. And thank you and we'll send out everybody. I know you asked a lot of good questions. We'll send out his contact information. And yeah, that was the purpose of this event, is like putting like, hey, own a business, get some tax strategy, create some cash flow. Maybe if you want to keep your W-2, keep the W-2. If you want to quit. You can build, solo 401ks and retirement vehicles that are available, and you can really grow your legacy. So thank you for all your feedback today. It was really good.
I think that's a really critical point, especially for people who are maybe a little bit later in life, maybe didn't save up for retirement. Self-employment, owning your own business is a perfect way to like super launch, your retirement savings into the stratosphere, because you can really catch up quickly.
Very good.
Absolutely.
You're right. All right. Well, very good. Thank you, Michael. Appreciate you.
Yeah. Thanks, Beau, for having me. It was fun. Let's do it again sometime.
Yeah.
Take care, everyone.
Thank you so much. All right. Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.